In today's video, we're going to be discussing Monte Carlo simulations. What is it? Why is it important? And what are really the most relevant use cases? This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So Monte Carlo simulations are a very important tool when testing strategies or when doing back tests more broadly. And what exactly is a Monte Carlo simulation? Well, quite simply, it's taking the trades which are produced in a back test or even in a forward test and just permuting them. And what permuting means is change the order. So let's say in scenario one, these are the same trades where we have 3 losers and we have 1, 2, 3, 4 winners. And in the first scenario, let's say we first have a win, then we have a loss, then we have a cluster of wins and then 2 losses. If you were to be trading this expert advisor or even taking these trades manually, you might think this is a pretty good system. Like here, if you did this over the span of 1 week, you should be profitable, assuming a 1-to-1 risk reward. Maybe here you have actually a positive risk reward, so you could be very profitable, and you'd be rather happy. But let's say the second thing were to happen, the second sequence of trades were to happen. If you had 3 losers in a row, maybe you just give up before the 4 winners happen because you think, oh, this strategy, this bot must be terrible because you have a sequence or a series of losers up front. And obviously this is a fairly short example, but this could be extrapolated out where you could have 1 amazing week or 1 losing week. And the main takeaway is that you can have a really good strategy, you can have a really good bot, but based on how you permute the winners and losers, you might actually have very different performance during certain periods. And by running Monte Carlo simulations, you pretty much run a bunch of different permutations so you can see how your equity curve would look if the trades were in different orders. So this can really help you know what to expect, because let's say you run a basic MetaTrader 5 back test, you might see that, hey, my drawdown is 10%. But that 10% drawdown assumes a certain distribution of winners and losers. Let's say you permute it, all of a sudden your drawdown can be 25% or 10%. So if you then forward test or run this bot live and your drawdown is 12%, you know that, okay, maybe it's not broken, maybe just the permutation is a bit different. And one of the most important things in trading, provided you have good bots, is knowing if your bot or if your strategy is broken or if it's still just in like a normal drawdown. And one of the biggest mistakes that people make is they remove or they add or they change things too soon before the edge can play out. So let's say you have a nasty drawdown, you remove a bot, but then because you removed it, you don't actually benefit from the recovery once it starts to make new highs. So really, as a trader, you want to be confident that your strategy has a real edge. You want to be confident that what you're currently seeing in the real live market is in line with what the statistical outcome should be. And Monte Carlo simulations, the most important thing about them is they tell you what to expect and they give you confidence intervals. So you know that, hey, if I'm seeing a 35% drawdown live, that should only happen in the 99th percentile of this particular strategy. That means that this is a very unlikely outcome given all of the different simulations which I've run. So this is telling me that something is clearly very broken and this particular bot should be removed. However, if you know that in 75 out of 100 simulations you ran, so different permutations of winners and losers, a 12% drawdown is perfectly normal relative to the 10% you're seeing in your basic MT5 backtest, then you could be not alarmed and just say, okay, in the current market regime, perhaps the drawdown's a bit worse, but nothing is potentially broken. So this is why this is such an important and such a helpful technique, because it gives you a much better view of what to expect when running a system live. And let me just go to the next slide. This is also an incredibly important factor when looking at martingales, because martingales usually assume that you can't have or you won't frequently have a run of many losers in a row. Because with martingales, as you can see in this graph, after a certain amount of losing trades, or on each losing trade, you usually re-enter with an increased lot size. And what blows a martingale is if you have a run of 4, 5, 6, 7, 8 losers in a row. And that's typically what causes these bots to go. However, if you run a back test, you might see like everything looks fine because we never actually have a run of 7 losers. But that's all based on historical data, right? If you were to run a million permutations, you are 100% guaranteed to have many runs where your grid will blow. So by running a Monte Carlo simulation, you can see just how risky martingales are, because by permuting the trades, you actually enter these big grids and your odds of blowing are significantly higher. Therefore, if you're somebody who wants to actually use a martingale system, which I would not recommend, but some people like it, you should then run a whole bunch of Monte Carlo simulations so that you're able to see what is my real odds of actually blowing up, and not just on an over-optimized backtest, but if you were to actually introduce randomness into the order of the trades. So how exactly would you run a Monte Carlo simulation? The first thing you have to do is run a backtest. The most critical part here is run a fixed lot backtest. And the reason why is if you're using a percentage of your balance, unfortunately, like the lot size is going to scale as you become more successful. And what that means is that the trades at the end or at the tail of your backtest, let's say you're running a 1-year backtest, in theory, in December, you should have made money, so your trade size should be bigger. Right? So then it doesn't make any sense to use a percentage-based lot sizing here, because you're going to have, you're going to be trading with way more size in certain parts of the year than other parts of the year. Therefore, using a fixed lot size is critical. Afterwards, you would typically export your trades either in HTML or CSV from whatever backtesting platform or MT5 you're using. And then you can then either permute them in Excel or with a tool. And the main thing is that you want to see what your worst case drawdown can be in the Monte Carlo simulation. So now I'm going to show you guys a tool which can actually be rather helpful for doing this. You're also able to do the exact same thing using Excel. There's, I'm sure, a bunch of tutorials on YouTube which will show you exactly how to do that, but there's quite a few functions which enable you to randomize as well. You can always Google Excel randomizer functions, but this is the Quant Analyzer 4, which is a phenomenal tool, which I would recommend that individuals use if you are somebody who wants to take trading particularly seriously. So let me go and show you guys this portfolio. This is our prop firm bundle portfolio right now, where we're running a whole bunch of different bots, and this is a backtest since 2022. We have this beautiful equity curve where I believe we look at our statistics. We are having a drawdown of around 13% with around a 160% annual return. So it's a phenomenal system running both our longbow fund as well as our various market open breakouts. But the tab I want to show you is the Monte Carlo analysis, because here we're able to run 100 different simulations. And as you can see, it will essentially permute the order of the trades. And what you can see is if we look at the results with confidence levels, we can show the odds of backtest, the odds of having a certain drawdown at different confidence levels. That means that in the 100, so the absolute worst case scenario, our max drawdown should be 30%. But at a 95th percentile confidence interval, our drawdown should only be 24%. So that means that under the vast majority of situations, our drawdown should still be very reasonable, because our original is 12.83%. If we run 50 permutations, we're still at 13%. And if we run to a 95th percentile confidence interval, we're at a 24% 24% max drawdown. And then if we look at the risk of ruin, we can see that our risk of ruin is like exceptionally small, right? So unless we're trading with $2,500, and here I'm assuming that we're trading with $10,000, our risk of ruin would be 2% there, whereas our risk of ruin becomes 0 according to the simulations. Now, there's never a 0% risk of ruin, there's always a minute chance, but according to the actual calculations and simulations here, it would drop to 0% with this approach. So what this shows me is that this particular portfolio is not super sensitive to the ordering of the trades. And that's really important, because it shows that the actual strategy is the portfolio is robust over a long period of time, and you're not necessarily just preying on getting lucky. And that's also really neat, because it shows us like what to expect in terms of drawdown, when to necessarily know if something is broken, and it enables us to adjust the risk in such a way where we can target a certain drawdown. Personally, I would like to target relatively conservative drawdowns on my personal capital, whereas prop firms I can go a bit more aggressive, and this enables us to do just that. So my takeaway, Monte Carlo simulation, super useful tool because it really helps you know what to expect, which is also phenomenal for your mindset as a trader. So guys, hope you enjoyed the video. Let me know if you have any questions. And I don't have an affiliate link for this tool, but I would definitely check it out. I recommend it to all of my clients. Have a wonderful day. Take care.